This is Gordon Scott with a weekend update for the U.S. stock market and a couple of ideas, things to watch out for in the coming week. I want to look at this chart right here and let you know what's going on with it. This is a look of the sectors, the comparison of the various U.S. sectors. These are the major portions of the market. And the ones that are really important, I have put dots on the lines, and so these are the ones. So the U.S. market sort of rebounded last week, finally kind of hit bottom and came back up. The S&P 500 is almost back up to its old highs, and Nasdaq and the small cap Russell 2000 are not back up. The big question is, will they begin turning up? And I believe the answer to that is yes, because both Apple and Microsoft had a really strong day on Friday, and so I think that we might see a little more selling through this coming week, but certainly we will have what's called a Santa Claus rally somewhere about December 15th all the way through the end of the year and into January. We'll probably see the markets moving higher. The U.S. market's moving higher, assuming that they're done with the little dip. Now, as I say, there's a good chance it could lead back down, and the reason for that is that I think that required minimum distributions are kicking in for people's retirement accounts. That's a little more lengthy subject, which I'm actually going to cover on Monday, but the bottom line is that some people have to take money out by the end of the calendar year, take money out of the stock market. Not a lot, but enough that it could nudge the sellers and maybe kick in some algorithmic selling pressure and influence on the indexes over the next week. But either that happens or it doesn't. One way or another, they sort of find a little bit of support. Of course, they're meeting this weekend. The U.S. government, Congress, is meeting to raise the debt ceiling to do this deal, and of course they're going to get it done. The question will be, what terms they come up with. But the big run up on Friday was in anticipation of them getting this deal done. Well, the deal just means that the U.S. government can keep spending money that it can't account for immediately, but so that they can keep paying all of their far-flung employee apparatus and various social programs going. I mean, it's a lot of countries have this same kind of dynamic. The U.S. government just has this weird need to keep increasing their credit limit, so to speak, every so often, and they're in the crux of that right now. If the market thinks that it's a good thing for the U.S. government to do this, then we probably won't see any sort of dip. If, in fact, the terms come back a little bit more questionable, or that somehow market thinks that that's bad for the economy, then we will see a bit more selling this week. And it's hard to say because, the Nasdaq's still down, but the S&P is up strongly. What that really means, though, if you look here, you can see is that people are generally bullish, but they kind of want to hedge their bets. So if you look at this, the two sectors that are leading are the technology sector, XLK, that purple line, and XLP, consumer staples. Consumer staples is stuff people need, toothbrushes, toilet paper, and so forth. And that whole sector is doing quite well at the same time as technology. It's a little weird because usually the growth stuff goes or the defensive stuff goes. The defensive is the consumer staples. And they're both going at the same time. So I think that that's the market showing this sort of schizophrenic ambivalence. So like, I want to invest, but I also want to be safe. How can I do this, right? So that's what they're doing. They're splitting their money between technology and consumer staples. Well, consumer staples and technology, the company that most embodies the connection of those two on the planet would be Amazon. So Amazon should be a good deal right now, right? Wrong. So look at that chart, ugly looking. Now this is a thing. When you come across an idea like this, where you see sectors or whatever doing something, and you say, all right, that should logically follow that when you go looking for it and you see that the stock is not responding, then you know that stock has other problems going on. And it does. I mean, Amazon probably has exposure to the weakness of the Chinese markets. That would be my guess. In any event, Amazon's going down. So if Amazon's not doing well, who is doing well? Well, that answer is pretty easy to find. Basically, anything you could call Amazon's competition. Walmart, Costco, Procter & Gamble, McDonald's Corporation even. Look at all of them. Look at what Costco and Walmart did. Just right after earnings, Costco went and hit an all-time high. This is just the beginning. Yeah, Costco's clear up at $550 or more per share, but this is Costco is probably going to have, in this time of inflation and this time of general, a lot of people want to say the economy is doing poorly in the U.S. That's not true. The economy is doing quite well. It's just that people aren't used to the high level of prices and so forth. And so, how do they respond to the fact that they have money, but everything costs more? You could go to a place like Costco and shop there. That's what they do. Walmart, similar situation. So both of those are doing well. McDonald's is also, when consumer staples do well, McDonald's tends to do well. Also, Procter & Gamble, the company supplying all of these consumer staples stores and companies. So these are the kinds of stocks that are doing well right now. But it's a bit of a inflation play, because it's not simply that, everybody thinks the market's going to go bad, so they're putting their money in these defensive stocks. No. It's because these stocks are likely to be able to raise their prices even and not lose customers. Even if inflation comes along, and they can raise their prices because people will still come to them. And there is one other inflation hedge. You might have heard people say things like, well, inflation's coming, and if you're in the U.S. markets or whatever, you've got to hedge with gold or Bitcoin. If you checked out those charts this past week, those things are not going up when inflation fears are mounting. But what is? The answer is real estate. Not just any real estate, not commercial real estate in the United States, but home builder real estate. The ETF that tracks that industry is XHB, and you can see it's trending up. Among the stocks in there, D.R. Horton is the largest, single most influential home building company in that sector. Home Depot and Lowe's are also, they also benefit. You can see all these stocks are going up. But the one stock you probably want to pay closest attention to is TPH, Tripoint Homes. They're not a household name, but they are a strong company. And you can see they've gone from 22 to 28. That's about 30% increase here in the last 2 months. And as I say, they're probably just getting started. It's not the time of year in the U.S. for home sales to be, we're coming into winter. This is actually a time when home selling slows down just a little. So clearly people are expecting more growth to come in the coming year, because interest rates are, the rumor that interest rates is going to go up sometime in 2022. That means people are going to rush to lock in mortgages with low interest rates before they creep any higher at all. And that is just going to help home builders have a pretty good next couple of quarters. That's what I think we're seeing here, is the anticipation of that move. And that it is playing out, that people are still buying homes. It's still a buyer's market in most of the states of the United States. And so this sector, or this industry, home builder industry, if it's going up, the rest of the market is likely to keep going up. It's kind of a canary in the coal mine, so to speak. If all of the market starts getting weak and you think the U.S. market is going to go into a bear market, you would see it happen in this industry, in the home building industry, first. No sign of that happening. Quite likely we can expect to see the markets rise, generally speaking, through the next couple of months at least. And if you want to get into more detail, show up on Monday morning at the hour that the U.S. stock market opens, and we'll be there to talk about what stock to trade. Until then, take care and trade well.